what if your retirement savings could ride the wave of high-return assets like private equity or real estate? But with a twist that might shake up your financial future. President Trump's latest executive order is stirring the pot, and here's the catch. It's not just about letting Americans invest in alternative assets. It's about redefining the rules of the game. But here's where it gets controversial. Will this open the floodgates to better returns, or is it a recipe for chaos? Let's break it down. The executive order, titled Democratizing Access to Alternative Assets for 401k Investors, doesn't rewrite the law, but tells the Department of Labor to rethink how retirement plans can include assets like private equity, real estate, and even cryptocurrency. Imagine this. Your 401k could soon hold stakes in a startup or a commercial building, not just stocks and bonds. Sounds exciting? Maybe, but it's a double-edged sword. Supporters, like the American Investment Council, argue that private assets have been a goldmine for pension funds for decades. They claim these investments offer stronger, long-term returns and diversification. Yet critics warn of hidden dangers. Economist Gopi Shah Ghoda of Brookings Institution raises red flags. Alternative assets are less liquid, riskier, and often come with sky-high fees that could drain savings. The question is, are average investors ready for this complexity? So, what's in store for retirement plan administrators and employees? Let's dive in. For administrators, navigating the new frontier. Simon Tang of Acalex, a fintech firm, calls transparency the elephant in the room. Private equity funds guard their data like a dragon hoards gold, making it hard for everyday investors to track performance. To bridge this gap, Tang argues, administrators need AI-driven tools to parse and present data clearly. Otherwise, they'll lose clients to competitors who can. Bill Cox of KBRA adds that while private markets can boost returns, they require meticulous due diligence. The right manager can make or break your portfolio, he says. And the stakes are rising. Over the next 5 years, the gap between top-tier and average fund managers could widen dramatically. But here's the kicker. How do you pick a winner when the track record is murky? Carol McLarnon, a financial services attorney, warns of a legal minefield. Excessive fee lawsuits are a growing threat, especially if investors feel misled. Her advice? Stick to pooled funds managed by experts if you lack in-house expertise. John Hunt of Sullivan Worcester echoes this, stressing that fiduciaries must weigh risks and expenses carefully. After all, if a plan crashes, the legal fallout could be catastrophic. For employees, the good, the bad, and the uncertain, Rob Sickle of K.L. Gates urges employees to ask, are these investments prudently designed for retirement plans? That means checking if a fund's fees are fair, if it's liquid enough, and if it's overseen by a qualified fiduciary. It's like choosing a financial GPS. Without a clear roadmap, you might end up lost. The Private Equity Stakeholder Project, PESP, throws cold water on the hype. They argue that private equity's returns often fall short of the SP 500, and when they do, the fees eat into what little profit there is. Plus, pulling money out? Good luck. Unlike stocks, private equity investments can be locked up for years with no guarantee of value. It's like buying a house you can't sell for a decade, one expert quipped. Russ Ivanjak of Aon recommends a cautious approach. Private assets should only be part of professionally managed portfolios, not DIY picks. Let the experts handle the heavy lifting, he says. But here's the rub. Who ensures those experts are truly competent? What's next? A game of waiting. The executive order is just the starting line. The Department of Labor has 180 days to draft new guidance, but experts like John Hunt insist this isn't a quick win. This won't change overnight, he says. The real test will be whether the benefits, like higher returns, outweigh the risks of fees, illiquidity, and complexity. So what do you think? Is this a breakthrough for retirement savings or a gamble with hidden costs? Share your take in the comments, because the future of your 401k just got a whole lot more unpredictable.